Hello, this is Pat Walker at Mission Winners. I'm doing a training coaching video here on a very serious discussion. Of course, my philosophy is this. Any topic related to investing is a serious topic and discussion, and it needs to be handled just as so. So here's a question for you. What moving averages do you use? I want you to think about this. It's a serious question. Right now we're looking at the spiders daily. Just to clarify, on my system, the purple's 200, the green is 50-day simple, the blue is 21-day exponential, 21 exponential, the yellow is 8-period exponential, 8 EMA. We're going to talk about the 8, and I'll share something with you. I've been doing this since 1986. When I got started, personal computers weren't invented yet. To do charts, you either had to draw them by hand or subscribe to a service that provided charts. At that time, I subscribed to Trendline. Eventually, in the late 90s, I started following Bill O'Neill, and I actually had lunch with him and sat down and talked with him about different things years ago. And I'm very grateful for that. He's one of my heroes. Went in, and he started talking about different moving averages. And we talked about the 50 and the 200 day, which is great. But for fine-tuning, I started, through research, using the 10-period simple moving average. The 10-period simple moving average. And it worked great. Just for clarification, there's a couple of big primary moving averages that everybody uses as far as type. Not number, but type. One of them is the simple moving average, where you just take, if it's a 50-day simple, you take the closing price for last 50 days, add it up, and divide by 50. Well, we don't have to do that anymore because of computers, thank God. Another moving averages that a lot of people use is either the 20 simple or the 21-day exponential. Both are very useful and practical. I have found that this is better, the 21-day exponential moving average puts me a little bit closer to price movement without being too close. You never want to be too close because you can get chipped around all the time. And we don't want that. We're not day traders, and I'm not in and out. Oh, it's above the line, it's below the line. Oh, we're going long, I got to sell. No, that'll drive you nuts. This is what we found through 30 years. The best thing that we can do is try to buy great stocks at great prices that are in great groups in a great market, and let the stock trend work for you as long as possible. You know, there's a myth out on Wall Street, and it's this. This is a lie. You'll never go broke taking a profit. Folks, that's a lie. You say, what? What do you mean? No, I'm being really blunt with you. If your losses are bigger than your profits, you're going to go broke. So we have to find a methodology that's relatively simple, that a sixth grader could understand, and allow the stock to work for us. And when I say work, I mean trend. A stock that can trend for us. What did we find? For years, my trading partners and I, one of them's out in California, used the 10-period simple moving average. And it worked awesome. It worked great. Well, I started doing a lot of research. And I did a tremendous amount of research on a man named Ed Sakota, who's one of my heroes. And I'm also grateful to have sat and talked with him one-on-one. And man, did he challenge me. Holy cow. He probably doesn't remember it, but I do. And it was great. Very, very good conversation. Ed Sakota, if you read Market Wizards, which is a great book by Jack Schwager, highly recommended, especially the last chapter with the interview with Dr. Alexander Elder. And what does it have to do with? It has to do with trading psychology. And excuse me, it's not Dr. Alexander Elder, who's also a very good with what he does. It's Dr. Van Tharp, Tharp. I had to get that right. I got to thinking, nope, that's not it. Dr. Van Tharp. He is an individual he's a coach. He's either a psychiatrist or a psychologist who helps traders, investors become better by challenging themselves. So in Market Wizards, the first book, there's an interview with a man named, as I said, Ed Seykota. Ed Seykota uses the 5-period exponential moving average. Well, I looked at what he's done. I looked at his returns. He's an MIT graduate, means he's fairly smart. And I thought, you know what? If it's good enough for Ed Seykota, by Jove, it's good enough for Pat. I'm going to start using the 5-period exponential moving average. And so I did. And here's what I found. The 5-period exponential moving average was constantly, when it would breach the line, was constantly getting me stopped out of stocks. They'd drop below the 5 and I'd sell. And it's like, and then what would happen? The sucker would turn around and come back. This was happening all the time. It drove me nuts to get stopped out. So I went on a vision quest. I said, I got to do something here. So I went back and I looked. And I did this with my trading partner. We went in, and again, I'm going way back, folks. I'm going back to the turn of the century type of stuff, okay? Actually, a little bit before then. We started looking and doing studies on the 10-period simple. And then we started doing more studies on the 5-period exponential. And then we switched around, and we did different combinations and studied on the stocks, which one consistently kept us in, but which one also got us out at a good price. And here's what we came up with. We found out that the 8-period exponential moving average was the solution to our problems. The two problems, not letting stocks trend long enough, and B, getting stopped out too quick. So we went with, as I stated, the 8-period exponential moving average. And that's what I use. And I will tell you, it works great. Now, I'm going to pause and say this right up front. If you have found a moving average that works for you, stick with it. Stick with it. That's great. Everybody's always flipping around. I got to try this. I got to try this. No. Find what works for you. Find what consistently works for you through different market environments. Because some people say, well, I'm just going to use the 200 day. Okay. Does it work in all types of environments? Are you going to miss way too much? Are you going to give back way too much? Things that you have to measure in relation to your investing style and tactics. So again, we blended it. The 10-period simple and the 5-period exponential moving average line. We worked on the 6-period exponential moving line. We worked on the 7-period, the 8-period, the 9-period, the 10-period exponential. We contrasted it with the 10-period simple, the 9-period simple, 8-period simple, 7 simple, 6 simple, 5. And through putting charts side by side and determining which moving average, and I mean, folks, we spent a ton of hours on this. This wasn't just shoot from the hip. Well, that's it. Let's do it. Oh, no. We tore it apart. And the conclusion we came up with was this. The 8-period exponential moving average will let us ride trends for a long period of time. If it starts to lose that moving average, we can sell some off. Do we sell all of it off? No. And by the way, I got to share this with you. We don't day trade here, okay? I'm talking looking at daily and weekly charts and sometimes hourly to fine-tune an entry or an exit. But other than that, no 5-minute charts. We let it work as long as we can. And I'll say it again, that moving average can keep us in for a long time. Here's a case in point, a real case, not hypothetical, the real deal. right here. Tesla lifted through a spot right here. Volume pickup, max list stock. Mission Winners max list stock. We bought it right here, and I can document it. Entry price, $338.30. And I want to show you something. Lifted right here, volume pickup. Advance it. The yellow line right there is the 8-period exponential moving average. I'm going to spread this out so you can see it easier. This is important, all right? Years of work in all this. By the way, you can say, why are you so serious about this? Hey, I'll tell you what, I was a sole supporter for 6 people, and my wife was a stay-at-home mom raising 4 kids. And, I thank God for her. And that's what we did. And I had 4 kids in private school at the same time. I had to make money, okay? But I also had to ride trends and control risk. This is the 8-period exponential. Watch it. Walks. And now look at this. You go, oh, it's down to the 8. You got to sell. Did it close below the 8-day, folks? Look close. Did it? No. Gaps down and reverses right back above the 8-day exponential. And marches. No closes below the 8. It breached the 8, but did it close below the 8? No. Now, could you sell some in strength? Sure. You're darn right. You're up 200 points. Do you sell it all? No. This is another myth on Wall Street. Again, I've been here to do this since 1986. Oh, you'll never go broke taking a profit. That's a frickin' lie, okay? If your losses are bigger than your profits, you're going to go broke. So you can dispel that one. Resting on the 8. Bounces off the 8 on a volume pickup. Comes off to the 8. Breaches the 8 but closes above it. Marches up the 8. Up the 8. Now it's getting loose up here and we're selling into this strength, okay? You get an emotional gap up bar like this, you've got to manage it. But I want to show you something. Did it close below the 8 on this bar? Did it close below the 8 on the other? Team, this whole move, this stock never closed below the 8-day. On the 8. Bounces off the 8. Gaps up. This was a telltale sign to be cautious. You can say why. See this bar? See the volume on that bar? You see this bar as it's lifting off? Is there any power on that bar? It didn't even do average daily volume. And then it gaps up to near old highs. How's the volume on this bar? Look at the volume on this bar versus that bar. There's not as much power. You got to be careful with that. In other words, the spaceship had a lot of power on this liftoff, and the next time it starts to lift off, approaching these spots, doesn't have the power. Drops a bit, less than average daily volume, but this is a warning sign here. Inside bar, you're okay. You're okay. But again, you put these in context, you're selling some into strength, and then it drops, and it starts to lose an 8-day, and you sell more. You sell more. Down to the 20, boom, right here, loses the 20-day on volume, we sold the rest. Bounces back, and that's all she wrote. All she wrote. Look at that. Day near a round trip. Almost a 600-point profit, and you've got nothing to show for it. Anyway, I wanted to share that with you. It's what we do. We look, bounces up, flopping around here now, okay? And that's where we're at, flipping around. Manage your stocks. The moral of the story is this. What I have found that works great is the 8-period exponential moving average. Am I telling you to use it? No. But I'm saying for good trend following that you're close enough that you can ride it, but not so close that you're going to get shaken out on every little wiggle, it works. After you've got a good trend, you give it down to the 20-day, you give it down to the 50-day, and it helps you. Trends pay. Trends pay. And again, there's a story related to Ed Seykota, S-E-Y-K-O-T-A. If you don't know anything about him, do some research on that man. Just amazing. He is one of my heroes. So Thank you very much.
Thank you for watching the video. We hope you enjoyed it. If you did, please hit like. Maybe hit that subscribe button. We come up with new content nearly every day. Also, check out the videos on the right. YouTube recommends the one on the top, and the bottom one is something we thought you might enjoy. See you next time.